Good morning and welcome to the Killik and Co market update. It's been quite a week. We've had the collapse of Silicon Valley Bank, or SVB. We've had concerns about the health of Credit Suisse, and we've had a UK budget that was a bit more dramatic than expected. Let's start with SVB, which is arguably quite a unique situation, and the problems there don't necessarily mean that we're in for another financial crisis. SVB was a bank that focused primarily on tech startups. In 2021, there was quite a boom in venture capital funds providing funding for these tech startups, so a lot of these companies ended up with very large amounts of cash that they deposited with SVB. So SVB therefore had a lack of diversity across its customer base, and it was also quite unusual in that it had a particularly high concentration of very large accounts, and that meant that only 12% of its deposits were protected by the Federal Deposit Insurance Corporation. SVB then made the decision to invest a lot of these deposits into long-term government bonds. Given that interest rates have gone up a lot over the last year, a lot of these government bonds have dropped in price. SVB would have been okay had its customers left in their deposits for a long time, allowing those bonds to mature, but a lot of the customers have been taking out their money over the last few months, forcing SVB to sell the bonds at very low prices, and therefore forcing it to crystallize losses. So, SVB is unusual for three reasons. It's overexposed to tech startups, a big chunk of its deposits were concentrated around very large accounts, and it used its short-term customer deposits to invest in long-term investments. The Federal Deposit Insurance Corporation has now taken over SVB and all deposits have been protected. However, investors have become concerned or nervous about other banks that also have quite a high level of exposure to tech startups, particularly regional US banks, which are subject to less regulations than some of the big global banks. For example, here's a chart showing the shares of First Republic Bank, which have plummeted since the SVB news broke. On the other hand, shares in big global banks such as JP Morgan have been very resilient, as you can see here. To illustrate the movements we've seen in markets this week, on this chart we're comparing the S&P 500 index in green to the banks within the S&P 500 index in purple to the regional banks within the index in pink. The Federal Reserve has now stepped in to support the banking sector by lending money to banks based on the face value of any bonds that they hold, rather than the current prices of the bonds in the market, which could be a lot lower. These loans have helped other banks to protect their deposits, and as you can see by the charts, the banking share prices have bounced off their lows since that support was announced. And also this week, there have been concerns about Credit Suisse, and arguably this too is a relatively unique situation. Credit Suisse is what's known as a global systemically important bank, i.e. it's too big to fail, and because of that it's subject to annual banking stress tests. These tests are very strict and they test to see how well the bank would perform in the hypothetical event of a number of negative economic scenarios. Credit Suisse actually did very well in the last set of tests and it was deemed to be very well capitalised. However, at the moment the bank is suffering from a crisis of confidence after being involved in a number of scandals in recent years, as you can see by the slow decline in its share price over the last 20 years. Credit Suisse recently has had to write off billions due to its exposure to collapsed US hedge fund Archegos and also the collapsed provider of supply chain financing Greensill. This week, the bank released a statement saying that its auditor had found some problems with its internal controls, which are now being rectified. However, because the market was already quite concerned about the banking sector due to the SVB problems, this statement from Credit Suisse caused a huge sell-off in the shares of Credit Suisse. And this was made worse when the bank's largest shareholder, the Saudi National Bank, said it would not be willing to invest more money into Credit Suisse. On Thursday, the Swiss National Bank agreed to loan Credit Suisse $54 billion, so this should further improve the capital position of the bank, which was already deemed to be acceptable. The loan was taken very well by the market and the market has performed quite well since then. It sends a very clear message that Credit Suisse is indeed too big to fail, and markets have taken confidence in the fact that the Swiss National Bank was willing to offer this level of support. Also this week we had the UK's spring budget, which wasn't expected to be particularly dramatic, but actually a few major changes were announced. The biggest surprise was the abolition of the UK's lifetime allowance, which is the total amount that any individual can have in their pension. Another big announcement was free childcare for parents of 1 and 2-year-olds. Our wealth planning team has put together a summary of the key points from the budget and how they could impact you, so please do get in touch if you would like a copy of that summary. Next week, we're looking ahead to results from Nike and Accenture. That's it from us. Enjoy the weekend, and we'll see you next Friday.